Now we're going to take a look at section 7.3, which is looking at more on the budgeting process. So the budgeting process. Now, the end result of the budget process is going to be a budgeted income statement and a budgeted balance sheet. So that's what we're working toward. We remember from financial accounting that we have a balance sheet, income statement, and those are showing, what we actually did during the year. But what we can also do, and we'll show you that later on in this chapter, we'll see that you can also create what's called a budgeted income statement and a budgeted balance sheet. And what that does, it just gives us kind of a prediction of kind of where we're, or a projection of where we're headed. So we kind of can see and have, a plan of what it is that we're going to have. Now, each element of the financial statements is going to be determined separately in a series of smaller budgets. So you're going to create different budgets that are going to kind of build up to this thing. Okay. The smaller budgets are used to create the budgeted financial statements. The smaller budgets can also be useful on their own to help department managers to run their section of the business. And so a flow chart of the budgeting process or master budgeting method is going to be shown next. It's also in your book at the top of 233 with major components in boxes and major information flows shown as arrows. So we see the different parts of the budget that, so there's the operating budget, and then you also get then the cash budget, and then you see how kind of the flow. So we have parts of our operating budget are going to be our sales budget, our production budget, our purchases budget, our cost of goods sold budget, our operating expenses budget. All of those items are going to go into and lead to our budgeted income statement, which will then also affect in our cash budget. And then obviously at the very end of that, it's going to affect our balance sheet. And then we also have another budget called a capital budget. And that also affects our cash budget and our balance sheet. The capital budget is for other things that we want to spend, not that are outside of operating, that are more what they would consider to be CapEx expenses. So larger expenses, things that we're looking to do for the business. So first of all, we're going to take a look at our operating budget. And so again, the first step in our budgeting process is that we want to create our budgeted income statement. And the first piece of that is creating our operating budget, which is a common term that's used to describe a group of budgets that are used to create the budgeted income statement. So we have a sales budget, a production budget, a purchases budget, a cost of goods sold budget, and an operating expenses budget. So our sales budget then is going to forecast the company's sales and revenue expectations for a given period. So it could be for the month, it could be for the quarter, usually probably the quarter or, leading up, to the year. So the budgeted quantity multiplied by the estimated selling price per unit of the products that we're planning to sell. And so the total revenue for the sales budget is going to flow to the revenue line on our budgeted income statement. And our cash receipts that are collected from customers are going to flow to our cash budget. So once we have our sales budget and we know how much we're going to sell, then if we are a manufacturing company, we would then have to create what's called a production budget. And what that does is that's going to use the number of units that we're going to sell from the sales budget in order to determine the number of units to be produced multiplied by the cost of our direct materials to know how much we need to produce in order to have enough to meet what we wanted to sell. So we also have a purchases budget, which forecasts the amount of raw materials that would need to be purchased within a given period. And this, and the invoices for the total cost of raw materials purchased are eventually going to flow into the cash budget. So again, this would be if we're a manufacturing company, we'd have a purchases budget to look at how much raw materials we need. So now cost of goods sold budget outlines the total cost of producing the product. So we have the number of units sold per the sales budget multiplied by the total production cost per unit. And this cost would then appear on our budgeted income statement. And our operating expenses budget is the final component of the operating budget. And the operating expenses budget is going to list our indirect selling and administrative costs that get developed during this period. And these costs become a part of the budgeted income statement, and cash payments for the operating expenses are going to flow to the cash budget, what we're having to pay out. Now, another type of budget that we're going to create, and this is a special kind of budget, it's not part of operating, is called a capital budget. And this is used, it's a separate major component of the overall budget where major purchases and sales of long-term assets get planned. Purchases and sales from the capital budget flow to the long-term asset section of the budgeted balance sheet. And then the cash payments and receipts for this would then flow onto our cash budget. So examples of capital expenditures we might have might be building new buildings, remodeling new buildings, purchasing any kind of equipment that's going to be, and usually equipment is going to be defined by something that's going to be used for many years, or at least a number of years. So maybe even in our business, depending on what it is, we may need to purchase new computers, or we may need to purchase a new piece of manufacturing equipment, or a new truck, or we're doing renovations to our facility. Those would all be things that would be examples of capital expenditures that we would use the capital budget to capture those. And then our cash budget. So our cash budget, what it does is it's going to summarize all of our budgeted cash receipts and cash payments to forecast whether the company is going to have enough cash in order to be able to continue to be in business. And so the cash receipts are going to show us the collections from customers after the sale is made. We know that some customers are going to pay as soon as the sale is made. They might even pay even at that same time. And then some companies might have to send invoices to customers in order that they would be paid later. So if they extend credit to customers, then they would send an invoice and then they get paid later. Now, cash payments then are the payments that we are made when we're purchasing goods and services as a business. Some purchases are going to be paid for immediately. There's times where a business might purchase something and they're going to pay at the same time. And then some suppliers get paid after the company receives an invoice. So the company receives the product or the service, and then the company receives an invoice after that they would have to pay. Now, these timing differences for both receipts and payments are going to be crucial in order to forecast our monthly cash flow, because we know that we might make a sale, but that doesn't mean we're going to get paid right away, or we might receive something, doesn't necessarily mean we've paid for it at the same time. And so the conclusion of the sales budget is going to be the calculation of whether a company would need to increase its financing and borrow in order to cover its monthly cash needs. So it might be possible that a business might have a line of credit at the bank that they're able to draw upon in order to be able to borrow at certain times where maybe things don't quite line up the way that they ought to. So budgets are typically going to be developed in detail by month for the following year. All of the budgets can be presented in their individual form, or they can be gathered together into one large budget. The end result of the budgeting process is the budgeted income statement and the budgeted balance sheet for a particular period, and that's what we're working up toward. And we could use spreadsheet software such as Microsoft Excel or Google Sheets or anything like that, or OpenOffice. The calculation function, Calc, I believe it is in OpenOffice, or LibreOffice, you could use that. But you'll use a spreadsheet, could be used so that the amounts can flow to the other budgets very easily and calculations can be made. The one neat thing also with using a spreadsheet is that we're also able to run what if analysis scenarios in order to see the immediate effect on the budget if we change particular budget amounts. So if we change our revenue or if an expense changes, we can run a what if calculation to kind of see what the effect of that would be. All right. So what 5 budgets are going to be often grouped together and are called part of our operating budget? And if we look, it is going to be our sales, our production budget, our purchases budget, our cost of goods sold budget, and the operating expenses budgets. And then what is the purpose of the operating expense budget? Is it to forecast the budgeted quantity and the selling price of products and services sold? Is it to forecast the purchase and sale of long-term assets? Is it to forecast the indirect selling and administrative period costs, or is it to forecast how much product needs to be purchased? And it is to forecast our for our operating expenses. It is to forecast the indirect selling and administrative period costs. Anything that doesn't actually go into making the products that we're selling and selling those.